Hello, this is Chad Carnes, Chief Market Strategist at ETFGuide.com. Thanks for joining me today as I talk about volume and what it is really telling us about this stock market. There's countless arguments that volume no longer matters anymore in the stock market. Some recent media headlines capture this the best. Volume matters? Think again. Is low volume really bearish? Is low volume actually bullish? Most of these arguments, though, we feel are short-sighted in their viewpoints, and they're also simply based on false premises. Our analysis shows that there is actually a big red flag occurring with volume at these lofty price levels, and I'll take you through why right now. Using traditional measures, volume has indeed been falling since the 2007 market top. This is shown in the chart on the screen. In black is volume, and in red is the New York Stock Exchange stock market. Since the 2006 top, volume indeed has declined. The fact that volume is down and continues to trend negatively is no disputed fact. What is disputed, however, is the importance of volume and if the declining volume on the back of the rally since 2009 is meaningful or not. Traditional technical analysis teaches us a few key things. First, rising volume on rising prices is normal. This occurred in the late 90s. It slowed down and trended sideways to down, volume did, as the markets fell in the 2000s, and then volume again picked up and increased as the 2003 to 2007 stock market rally continued. So that was a healthy and normal market. Another thing that traditional technical analysis teaches us is that rising prices and falling volume is abnormal, which is what indeed has been happening since the 2009 low. Rising prices in red through the end of 2012, this is shown, and then falling volume in black. That is traditionally a weak and suspect rally. The main argument is prices have risen since the 2009 lows, although volume has been declining, therefore volume doesn't matter anymore, and that seems a little short-sighted to me. To assume something doesn't matter just because at the present time the expected outcome is not occurring, this certainly does not mean that the expected outcome won't eventually occur. It's like saying it's sunny outside right now, so a thunderstorm won't happen later. Or if you prefer a financial analogy, how about the housing market? It always goes up in price. Therefore, there's no risk of housing prices declining. Remember that one from 2006? Just because the market has risen on less and less volume does not mean volume should be disregarded as unimportant or that price eventually won't correct back to historical norms. And I'm going to show you why right now. This next chart is one I created, a proprietary chart that at ETFGuide.com we provided for our subscribers in our December newsletter, showing the Dow Jones Industrial Average in red and its total capital traded index in blue. And total capital traded is a formula that we made that captures the average daily volume and the average daily price of the stocks of the Dow Jones Industrial Average to come up with a total capital traded each day index through time. During the 90s, you can see that the Dow rallied in red along with the total capital traded index in blue. This was a healthy and strong market. In the 2000 recession, the Dow fell and the total capital traded went sideways and fell for a little bit, and that was normal. And then again, in the outlined area 2, the Dow Jones Industrial Average rallied through the 2006 top along with total capital traded. Money traded was going up, as was the Dow Jones Industrial Average. That was normal. And then when the markets fell, so did the total capital traded in 2008, and that was normal. But something happened after the flash crash in 2010. The markets kept rising after the flash crash, but total capital traded has completely dried up and at levels back to 1999. With average daily capital traded back below $10 billion, it's clear that the market's rally since the 2010-2011 time frame is abnormal and not built on normal supply and demand metrics. What it is built on, who knows? Could be anything. But this indicator is potentially warning us that in order to bring back prices in line with demand, another huge sell-off or rogue wave, which we've written about a few times in some of our articles found on ETFGuide.com, maybe lurking around the corner. This is why we've been recommending the VIX calls like we did on February 6th when the VIX was below 13, and we reiterated to our subscribers of the technical forecast on February 10th to continue to hedge downside risk. Those VIX calls more than doubled recently when the VIX hit 19 a few weeks later, and based on the volume trends that we're seeing and the expected return of the market to more normal levels, we think we'll get plenty of other opportunities to buy the VIX down the road. Thank you for joining me today as I looked at volume. You can find some of our other videos on our YouTube channel as well as on our webpage, etfguide.com. We offer a monthly newsletter, weekly ETF picks, and I also do a few times a week technical forecasts. Thanks for joining me.